Hey there, emerging expat! You're tuned in to Let's Move to Portugal. I'm Victoria from Expats Everywhere's podcast, and I have the distinct honor of bringing you, YouTube travelers, and our resident Portugal experts, Expats Everywhere's Josh and Kaylee. Each week they'll inspire, they'll educate, and they'll accompany you on your journey to Portuguese residency. This week on Let's Move to Portugal, join Josh as he discusses the complexities of U.S. tax obligations for expatriates with tax expert Stephen. The conversation also includes the intricacies of tax credits and exclusions and the importance of understanding filing deadlines.
Hey expats and travelers alike, welcome back to Expats Everywhere Presents Let's Move to Portugal podcast. And this is episode number 100.
Woohoo!
Yes, Kaylee, how you doing?
I'm doing well. It's pretty exciting. How are you doing?
I'm doing really well. I'm excited to have 100 in the bank. We're in rarefied air, if you will. There's like under 5% of podcasts that make it this far.
To 100 episodes. It's crazy that it's already been 100.
Yeah.
I mean, I guess it's been a couple years now, right?
Yeah.
So-
It's a good 2 years of putting out episodes, publishing episodes for you, listener. Just to let you know, if you're new, thanks for joining us on this one. I think it's a special one that is going to bring in some new listeners because we do talk about taxes.
It's a funny
really
100.
Funny at 100. Yeah, and it's not very exciting, but it is. It's an important one.
Yeah.
So yeah, if you're new here, the way the format of this show works is we start out with an introduction from our producer, Victoria. Then we move into this portion that we call the weekly welcome, where I welcome you every week.
Hey, I welcome you too.
And we talk about what's been going on in the world of expats everywhere. And then we move into kind of the main point of the episode,
of the podcast. Yeah.
which is usually an interview, but sometimes we do kind of other things.
Speaking with experts on different topics that are important for living abroad, not just in Portugal, but living anywhere. Right?
Exactly. That's
Yeah.
exactly right.
So it's taxes for this one, which is not just for Portugal. It's just if you're an expat and you decide to reside somewhere else outside of the U.S., then you need to know what your tax implications are, I guess.
Yeah, absolutely.
stuff.
I think it's important to know that and just be prepared before you move. But if you're in
Yeah.
the middle, if you've already moved and you're not sure and tax season is upon us,
Yeah.
then I think Stephen's going to get you caught up to speed. Don't hit the panic button. It is okay. And everything will be okay. I think
Yeah.
we clear up a lot in this episode. He's actually someone that we had on the main YouTube channel. Gosh, probably
Years
5
ago,
years
yeah.
ago now. So
Mhm.
we wanted to make an updated one. Obviously, we have better technology now. We sound a little better on the mics. So we were able to get another episode published. Not a whole lot has changed.
Yeah.
But Stephen was lively this time. So
What's changed is his beard.
His beard.
From
oh
years
man,
ago.
it is big.
That's funny.
Okay, so just to let you know, we have created 2 pieces of content out of the same piece of content.
Mm.
And what I mean by that is you're listening to this, and if you're listening to this on March 11th, 2025, that's the day that we publish it. And it's about 50 minutes long. Well, the podcast in total will be about 50 minutes long, but it's the whole episode. We make some angle changes, but we don't cut anything. However, for the YouTube channel, which is going to go out on Saturday, that's going to have edits. It's going to be paced a little faster. We remove some of the stories that Stephen tells so that
A shorter version.
Yeah, we get a shorter version out
More
to the YouTube
precise
community.
answers on the questions that are asked.
Yeah.
Right.
So-
So we have it on both.
We're going to put the questions in the description section of the YouTube video. But feel free to skip around if you'd like, but I think it's probably really valuable to kind of listen to the whole thing and
Mhm.
gives everything in context to one another because some things are connected.
Right.
Yeah.
But a little bit of what's going on with us. We just got back from Luxembourg.
Yes.
So we have Expats Everywhere
Just.
Explores. And a couple years ago, we put out a city guide. It was about the city mainly. A city country guide. I mean, the country's so small, of Luxembourg. And it did well. And we were there in the winter when it was cold. So we wanted to explore because we really enjoyed it. So we wanted to explore what it was like with better weather, do an updated video for everyone. And
Yeah.
so we just got back. It was great.
And we took Victoria.
Our producer, yeah.
Victoria
Mhm.
came with us. She's become a friend of ours. She was able to help out with Sia, our 5-year-old daughter, whenever Kaylee and I needed to film something.
She
And then
helped
also,
filming as well.
I handed her a camera and let her loose. So that was good.
Yeah, so we're actually going to talk about Luxembourg and how it compares to Portugal on this podcast as well, because there's actually a lot of Portuguese who are in Luxembourg. Excuse me.
Yeah, I mean, it's the most dominant foreign community in Luxembourg, which I
Right.
think would surprise many people because you're essentially on the border of 3 countries, right?
Mhm.
And one of those is the most, not one of those is the most represented foreign
It
population.
does not
That's
border
strange.
Portugal.
Yeah.
So it's a little weird. There's so many Portuguese there, but we heard so much Portuguese, lots of different languages. And actually, we're going to put out a video with Victoria because she's been in Portugal for 13 years now. So her Portuguese is really good. So we had her speaking Portuguese in Luxembourg.
But I mean, even we found ourselves speaking Portuguese. We would hear someone else speak it, and then we would jump right in. We had a couple hotel staff that were Portuguese. One girl is Luxembourgish Portuguese. So one parent is from Luxembourg, the other is from Portugal. So we were able to chat with her because she's always traveling to Portugal. So it was really interesting kind of hearing some of the, I don't know, the different takes on Luxembourg by these people that also know Portugal very well.
Right, that's true. And I think what was interesting as well is the accent. Like when we would hear recordings that were going, like at the airport, actually, they did a recording in Portuguese, and it was like, oh, that's interesting. It sounds different. It was clear though.
It was
a
clear.
little easy to understand. But anyway, so we will be putting content out about Luxembourg. It's definitely a great place to visit. Potentially move. I don't know. You have to wait and see if we would expat that.
Yeah. We also stumbled across a supporters club bar for Braga and for FC Porto.
Yes.
Saw a few Benfica jackets. Boo. And no, it was fun. Actually, didn't see any sporting.
Nope. Didn't see any of that ugly green color. It sticks out, that green.
It does. You can't miss it.
It's true.
Okay. So what else is happening? We've actually been talking a lot about Spain on the main YouTube channel because Spain and Portugal get compared a lot, and people are interested, I think, in both countries before they make a decision on where they want to live. So maybe you have been listening to other Spain adjacent YouTube content, and you're also thinking about Portugal. So we've been putting out stuff about that. The dual citizenship thing. Can Americans become dual citizens in Spain or keep their U.S. citizenship? Yeah. So we talk about that this past week. Yeah.
Tricky. So lots going on, but I guess let's see. With Stephen, let's shift over to what this episode is about. We mentioned it before, obviously. Woohoo, 100, and we're going to talk about taxes. A necessary evil, I suppose. But what I like about Stephen is he's so knowledgeable about, and his company helps expats anywhere in the world. So they're very knowledgeable about that, but what you should be doing for U.S. taxes. But something that he says, I think, towards the end, which I think is really good, is if you haven't been filing or you haven't been doing it the right way, it's okay. Like you were saying before, like if you already have moved and you're like, oh no, I don't think I've been doing it right, it's okay. There are ways to fix it that like won't sink you, I guess you could say. So if you haven't been doing stuff and you're not sure, you can rest assured that you can still sort it out and make sure that you're doing your tax right. Because American citizens, if you have an American passport, you're a U.S. citizen, no matter where you live, you have to file in the U.S. always.
Yeah,
that's something that you definitely need to know. So Stephen does a great job of explaining things.
Yeah, I mean, we have a personal anecdote whereby we have a friend actually that we worked with in Singapore that hadn't been filing, and then they needed to make a financial transaction in the U.S. They needed to buy a house and show tax returns.
Yeah.
And it's like they didn't have them to show. They had their Singapore ones, but they didn't have their U.S. ones. So Stephen was able to get them caught up and sort that out.
Yeah.
It didn't take too long relatively to do that. So for those of you who have been living abroad for a bit and you've not been filing back in the U.S., like I said, don't hit the panic button.
Mm-hmm.
But this should give you a good indication of kind of where you're at. And then if you need to reach out to someone like Stephen, then you'll be able to do that.
Right. And we've been using Stephen personally for quite a while. So we're very happy with him and with his company. And one other thing that I like that he says, and then we'll let him talk, but he says that we're expats as well. So it's a group, the company is expats, like a group of expats doing things. So it's not like there's someone sitting in the U.S. Telling expats how to do their taxes. So I think that is legit,
Yeah, absolutely. And one more thing about the 100th episode. We're just really thankful for your support because this podcast to us is a labor of love. We really enjoy doing it. It's a fun format for us to come on a weekly basis and just speak with you. And we do read your emails whenever you email us and have questions or want us to touch on certain topics. But it's one of those where your support has meant that we've been able to grow and we've been able to hit this milestone. And we know that we're going to be able to go past this milestone because of your support when you're, using the affiliates that we give shout outs to, or when you're working with the sponsors that we have on the podcast. So we thank you for trusting us in that way. We also thank you for supporting us to get to 100. It is a massive deal because
Yes.
I've read the analytics and not many podcasts make it to where we are, what the milestone that we've just hit. So it is kudos to you. You've put us in the top 5 of all podcasts worldwide. So it's pretty dope.
Thank you. All
right, let's get to the show.
All right, but before we do that, let's talk about this week's sponsor, Green Ocean Global Advisors.
Yes, we always recommend, no matter where you are in the moving process, to get your finances in order. So that's in your home country and then the country that you're moving to.
And speaking about homes, what if you sell your house before leaving or do it after? What are the capital gains implications like? Well, a financial advisor will be able to walk you through this type of thing.
And what about distributions? Maybe you have a 401k or a pension and you need to figure out how much you should be drawing from for the lifestyle that you're going to have.
Now, you can use this link in the description section below to talk to John from Green Ocean Global Advisors to see if he's a fit for you. You'll have a free 15-minute consultation just for being an Expats Everywhere listener. So you can use that to get your free 15 minutes. Click the link in the description section below. Now, on to the show.
All right, Stephen, really glad to have you back on. We're going to go through the most commonly asked questions that people have. I have to know, do expats have to file taxes in the U.S.?
Great question. And the answer is yes. Very simply, worldwide income has to be reported. Doesn't matter where you make it, doesn't matter what type of income, it's all got to be reported. Whether you pay tax or not is going to vary, but reporting is required for, once you're above the threshold of your standard deduction, everything has to be reported. And if you're not sure if I'm saying that accurately, in the back of your passport, if you look at it, there's actually a statement that's printed into every passport issued that says you're responsible to report your worldwide income back to the government. So it is something that must be done.
Okay. And you mentioned about might having to pay taxes. So what are some of the thresholds where someone would have to pay taxes?
So, yeah, I mean, the U.S. tax regime, as everybody knows, I think, is one of the most complex on the planet, right? It's one of those where there's exceptions and exclusions and options, and you could do it this way or do it that way, but if you do it this way, you can't do it that way. So there's a lot of variation of things that kind of come into play as one's looking at that, but there's a few kind of basic ones. The fundamental one that most people know or think about is what's called the I can't be double taxed theory. Right? They say, well, if I'm paying tax in one place, where it should be protected from double taxation. That's kind of true in the sense that the U.S. government, the federal government, does allow you to take credits for taxes paid to other countries against U.S. tax liability on the same income. So if, for example, you had a capital gain in the U.S. and you're living in Portugal or Spain or anywhere around the world, and you have another capital, they're going to tax you by the virtue of the fact that you're living there, then the taxes paid locally could be federally applied to offset that. So you would not necessarily be double taxed, but you could still pay tax in both places. If your local tax rate, say in Singapore, is a 10% capital gains tax rate, but the U.S. tax rate's 15%, you'd be in a situation then where you actually would be paying tax in both places. You just simply wouldn't be paying more than the net 15% when everything was included. So option one is this foreign tax credit idea. That really works well on the federal side. Most states, however, if you have a state filing obligation, most states don't accept that. So if you do have a state filing obligation, the foreign tax credit isn't going to help you. The other option that most people use, especially if they're working overseas, this is more for those working versus those retired or kind of in a separate phase of life. But if you're working overseas, is what's called the foreign income exclusion. And this amount varies year by year, but the government for 2025, the amount's $130,000. So if you qualify under one of their overseas residency tests, and there's two different ones that you can get into, one's called a physical presence and one's called bona fide. But if you can qualify under one of those two tests, then the first $130,000 you make, the U.S. government says, we're not going to tax you on it anyway. So there's either you could file the credit, you can file the exemption, or if your income is sufficiently high enough, you might be able to use both of them. The key, though, is with this type of structure is you can't go back and forth. If you start filing the tax credit, they will let you switch to the exemption, but you can't go back to the tax credit for 5 years. If you're filing exempt, you switch to the credit, you can't go back to the exemption for 5 years. So it's not just sort of what happens year by year that you have to think about. You also have to think about where you're planning to be in the future. If you're going to be in a high tax country for the foreseeable future, the tax credit might work. If you're going to move to Saudi Arabia and suddenly your income is going to be tax free, you don't want to be on the tax credit. You really want that bona fide exemption to be applied for you.
Can you quickly go through what the two tests are exactly, the bona fide and the physical presence?
So the physical presence test is used for someone who's temporarily overseas. It's a status that the IRS looks at and says, okay, you're overseas, but really you haven't moved your tax home overseas. You haven't shifted everything over there. You're temporarily abroad. And this might be for a variety of reasons, right? Maybe someone's working on, the oil rigs in the North Sea, right? They go out there, they work, they're on 6 weeks, off for a week, on 6 weeks, off for 2 weeks, whatever it might be. And the government says, okay, look, you're clearly not in the United States. You're not working here. You're not earning services here. So we're going to give you an allowance. But to qualify under the physical presence test is you cannot be in the U.S. more than 35 days in a 365-day period. We can look at the 365-day period, though, any way we want. We can say, for example, January to December, right? So if someone's overseas from January to December and they're not in the U.S. more than 35 days, then they qualify. They can have this foreign income credit or exclusion allowance. But let's say they go over mid-year, so they go over June 1st. We can look at the window from June 1st to May 30th of the following year. So the 365-day window can be any period of time. It can be February to February, March to March, April to April. It doesn't matter when that is, just can they find a period of time during which they were out of the U.S. 330 days? And if so, they're going to get some exclusion. The amount of the exclusion, though, depends on the number of days that fall within that calendar year. So if you get your exclusion from October 1st of one year till September 31st of the following year, then you're only going to get the amount of exclusion for the November-December period, which would be a prorating of that 130K amount that I mentioned. The key is if you're temporarily overseas, the idea is you have to keep yourself really out of the U.S. As much as you can, because that's going to give you the most benefit in terms of that. But it really is built for those people who are, maybe they're on sabbatical, maybe they're doing something temporarily. This really isn't an expatriate permanent status. It's just kind of maybe I'm doing this for a while because I enjoy it. The bona fide status is more of someone who has basically shifted their tax home overseas and quote unquote, no intent to return back, right? Now, intent can obviously change. I mean, someone could go overseas and plan to be there and then 3 years in decide that it's not for them and they go back. That's fine. But at the point in time of filing the return, if their plan is to be abroad indefinitely, then the bona fide one tends to fit better. The bona fide really, aside from having that requirement of intent to be abroad, you must be on a 2-year or longer contract. So you've got to have something that says you're tied at least for a 2-year period abroad, and in theory, hopefully longer. So the bona fide status, to qualify for that, you have to be an expat for a full calendar year. So if someone came overseas in June of 2025, their qualifying period would be January through December of 2026. So their tax return for 2025 would have to be extended all the way until January of 2027, so they have a full calendar year outside the U.S. Yep. Now, there's a specific extension the IRS gives for this to happen. So there's normal extensions, which are called 4868 extensions. That's pretty normal. But they have a special one called the 2350, specifically for people who are trying to qualify as bona fide abroad, but they haven't at the time the tax return is due. And so they'll basically file that. The IRS gives them the extra time to then qualify, and that status sort of retroactively applies back. That's really the best one because the time in the U.S. doesn't matter. You can be in the U.S. for as much as you want. There's no limitation on days. You do have to keep track of them. And if you're working while you're there, the income has to be adjusted for that period. But reality is that you can be there as much as you want, provided your primary place of employment remains overseas. So as long as you're earning the majority of your money and spending the majority of your time while you're abroad, then there's no problem to go back for 3 weeks in Christmas and go back for 6 weeks in the summer and take another holiday there. All of those are totally fine. Under a bona fide status, you wouldn't lose your eligibility on that basis.
Okay, nice. Well, you started talking a little bit about deadlines. So I wanted to ask you, when do expats need to file taxes by?
So the good thing is it's if you're overseas on April 15th, so the normal due date, if you're an expat abroad on that date, you have an automatic extension until June 15th. You don't have to do anything. You just get it automatically. Now, if you're filing on your own, you probably want to include some kind of statement with your tax return telling the IRS that you're overseas on that date, because if you just file it and claim that status, but they don't know that you were overseas, then they won't give it to you. So you make a notation on on your tax return, right on the top of it, expat overseas or whatever it might be, and then they would give you that extension. To get longer than that, then you have to file the form. There's a 4868, which should give you an automatic extension until October 15th. And then, of course, the one that I mentioned, the 2350, which would give you even longer if you needed it for that qualifying purpose. So those are kind of the deadlines for that.
Okay. Well, I wanted to ask you directly this question. You kind of already touched on it, but can expats deduct foreign tax credits?
Not in a tax parlance, let's say. So when we talk about a deduction, we're talking about an allowance to reduce your taxable income by some permissive measure. So the IRS has said, if you do, let's say, for example, one that everybody pretty much knows about is the mortgage interest deduction, right? So if you own a home and you pay mortgage interest on it, you're allowed to take that as a deduction on your taxes because the tax code allows it. So that would be a specific deduction.
Okay.
Foreign tax credit or foreign taxes paid are not treated as a deduction in most cases. There are some where it can actually function that way, but in most cases, it's taken as a credit. And a credit basically can only be used to offset against taxable income. So if your income is already, if you have no tax liability, then the credit doesn't really matter because it only can reduce what you owe. You don't get an extra refund back. You can't get more money than you paid in, anything like that. It just helps to reduce your tax liability down by taking the credit. The deduction actually reduces the income that's being taxed, and that doesn't really happen in a foreign tax credit kind of situation for most cases.
Okay, so earlier we mentioned about the foreign earned income exclusion. What is the foreign earned income exclusion?
Foreign income exclusion is primarily, it's just a part of the tax code that the IRS has had in place for a long time now. It simply says that if you qualify under the physical presence test or the bona fide residency test and you're overseas, that the first portion of money you make, we're not going to tax you on it. So you still report it, you still declare it, and then you also tell the IRS why it's not taxable. So let's say you're working as a teacher in Barcelona and your salary is $60,000 a year. So when you file your taxes, you report you made $60,000, and then attached to that tax submission, you're going to fill a form called a 2555 on which you kind of break down the reasoning for why you don't have to pay taxes on that. So you submit to the IRS a document with a breakdown of which test you're going to fit for the bona fide or the physical presence test. And then along with your tax return, you show, look, I made the $60,000, but I don't owe you any tax on it, and here's why. And so then that income is then basically given to that information is given to the IRS so they can determine, yes, in fact, you don't owe any taxes on that. The key thing with the foreign income exclusion is it's really the foreign earned income exclusion. And it's a key distinction because the money that can be exempted, it has to be earned income. It has to be money that you're earning from activity that you're doing. So passive income like rental income and capital gains or other things where you're earning money but you're not physically working to earn it, this foreign income exclusion doesn't apply to that. So if it's someone who's retired and living in Greece, they're not going to have a foreign income exclusion because they have no income or earned income. They're only receiving passive sources from Social Security or from their pensions or whatever else it might be. So it's only going to apply to those who have active earnings and then qualifying under that process.
And are there ways for people to optimize their taxes if they're earning in a passive capacity?
Yeah, I mean, it depends on the country and where they're living and how they're taxing it. So that's where really the tax credits would probably be utilized a little bit more. So if, for example, someone is, living in, most of the European countries, once you're there over 183 days, you're considered a tax resident. And they expect you to report your worldwide income to that country. So if, for example, you're living in Germany and you've been there over a year and you have a rental property in the US, well, Germany expects that you report that rental income to them. And they're going to apply their tax rates on that. And that's where you would first file your German return. You would calculate what the Germans say that you owe in terms of that debt. And then that credit of the amount you pay to Germany would be used against on your U.S. tax return to offset anything the federal government might want to charge you with. So that's where you'd be able to kind of be a little bit more economical in terms of your tax treatment of those things. But it really varies country by country because the rules are very different in different places. One of the good examples for example, in Portugal, there's IRAs and Roth IRAs that people in the U.S. generally will save into. Those are limited to what you can do overseas. That's a kind of a separate discussion maybe, but other countries don't recognize that. So Portugal doesn't recognize a Roth IRA. So even though the federal government says, look, this is a tax-free account, we don't pay any taxes on it, what have you, the Portuguese authorities may say, no, this is a pension like anything else, we're going to tax it. And so in certain cases like that, the US government wouldn't be taxing it. The Portuguese government would be. There's no tax credit you can take because there's no liability on the US side for you to use as an offset.
Okay. Some people have really simple tax situations in terms of like single source of income. When do you recommend someone hire a tax professional?
You know, it's a tough thing, right? It's not cheap, generally speaking, because there's a lot that goes into it and a lot of time that goes into the returns. But the overseas stuff is a lot more complex, right? And
Yeah.
I think it really depends on how much time someone's willing to put into it. And I'll give you more of an example. If you use one of the software programs, say, TurboTax or whatever, all the same forms are there, right? I think for TurboTax, to use TurboTax as an expat and have the form 2555, you need to buy the most upgraded or the highest package they offer. So whatever that is, $180, whatever, $200 for their highest level to get those forms. What happens is it's sort of like most things in life, it's a garbage in, garbage out kind of situation. It takes you through these questions and it asks you, do you have this? Do you have that? And as long as you're answering it correctly, the software should get you to the right outcome. The problem is if you don't understand what they're asking you, you can still get an outcome, but it doesn't mean that it's right. And so we've seen a lot of cases where with TurboTax, that we'll see a tax return where the tax shows zero income. Then it shows a foreign income exclusion of $80,000. And so their income is minus $80,000. So they have it minus $80,000. And that's what they file with the IRS. And TurboTax lets that go through. So it could go through, it gets filed, but obviously it's completely wrong because the income piece wasn't reported, just the exclusion piece was taken. And it threw the numbers off. So I think if you're going to do it on your own, which by all means that it's not a problem, whenever you generate the final PDF of the software, just take some time to look through it and see if it makes sense. Is my income all showing here? Can I see my income? Can I see where the exclusion is applied? Do these numbers actually make logical sense? And if they do, you're probably okay. But if you're seeing a minus $80,000, adjusted gross income and no income reported, you got to do something about
Something's
that.
not quite right.
Yeah. So just take your time to actually, work through that. And if you get to the point where you're uncomfortable or you feel like you need some support, then reach out for those kind of services and whatever. But we have a lot of people who will start with us. They'll do kind of their first year overseas because it's more complex. They have a half year of income in the US, a half year overseas. Yeah. It's more, now they've got to file these extensions to qualify. So they're a little bit uncomfortable with that. They'll usually start with us and usually they'll say, hey, I usually do my own taxes, but this year I can't do it. And then after we do them for them 1 year, typically they'll come back the next year and say, you know what, that was just too easy. I don't want to mess with it anymore. Keep doing it. But either way, we can be the resource as needed for those kind of things.
Well, as you know, Kaylee and I did just the opposite, whereby we started out doing our own taxes. We were living in Spain and our taxes were quite simple. Our income was quite low as we were both working for a Spanish school. I was working in a Spanish school and Kaylee was an au pair. So our tax situation was very simple. And then as we progressed, went to South Korea, then went to Singapore, got a few rental properties. We had multiple sources of income. Things got very complicated. And that's when we met you in Singapore and asked you to step in and help clean up our mess that we had made with TurboTax. So I still get those darn TurboTax emails every single tax season. I get bombarded. I need to just switch those off, but appreciate you stepping in to help out. Okay, let's move on. And we talked a bit about this idea of double taxation. How do people get themselves in a situation where they get hit with double taxes? Earlier, you mentioned this idea of Singapore having 10% for capital gains and maybe the US being at 15. So you would pay 10% to Singapore and then the other 5 would be to the US. Can you kind of clarify how this works?
Yeah. So, the idea that you don't have to pay taxes when you're overseas because you're paying taxes somewhere doesn't necessarily hold, especially if you're dealing with the foreign tax credit. Because really what you're dealing with there is a credit for local taxes against another country's tax regime. And by and large, in Europe, because you have so high taxes across the board for services and whatever that are provided, generally speaking, the taxes in Europe are going to be more so than what the U.S. tax brackets would be. Especially for westernized Europe, that would be the case. Now, when you get over into Asia, though, or Africa, or even South America, depending on the location, it switches the picture up. There's a lot of places in the Middle East and what have you where there's no income tax at all. So you can have a situation where you don't have those things to offset. But ideally, the U.S. calculates what they calculate based on their tax tables either way. So if you report and you make X number, you make $100,000 overseas, the U.S. government says, okay, based on this, you're in the 22% tax bracket. Here's our calculation for what you owe. And then from there, you're trying to offset that liability by what you're paying to another country. So if you owe the U.S. 22%, but you're in a country that only charges you 10, then there's a 12% difference that you have to make up, and that's where you'd still end up paying to both countries. You wouldn't pay more than the 22% collectively, but you'd still be paying to two different countries on the same income as part of that. So again, that's where deciding whether you're doing the foreign exclusion or the foreign tax credit becomes kind of a dynamic discussion there to see which is going to make more sense for you. If you're come from a tax-free state, so if you're from Texas or Florida or Washington or Nevada, what have you, and you have no state income tax and you're living in Europe, well, by and large, the tax credit's going to work best for you, nine out of 10. If you're from a state that doesn't recognize, like New Jersey doesn't recognize the foreign income exclusion, or Hawaii doesn't recognize the foreign income exclusion, you're going to pay taxes no matter what if you stay tied to that state. So one of the things we advise expatriates to do is, when you get the chance, is to try and move all of your official documentation to a tax-free state before you expatriate. So if you can go to, I believe South Dakota has a requirement that to be a resident, you have to spend one night in the state, right? So you go there, you spend the night, you get your driver's license, you get your PO box, and then you're out. And now you can be domiciled in the state of South Dakota as opposed to a higher taxing state. So if you're expatriating and you have time to plan it, looking at doing something like that is going to make your life a lot easier from a taxation perspective going forward by eliminating the state side of things completely.
Okay. Thank you for that. I think that's great advice about potentially switching states before you expatriate. I want to ask you, as we switch gears and talk about FBAR, I had a cheeky little look to see when FBAR reporting started. I'm seeing 1970. Now, I'm going to be honest, Kaylee and I found out about FBAR reporting much later. So what is FBAR, and what do people need to do?
Yeah, so the FBAR is the foreign bank account reporting. And it was something that did start in the 70s. And really the whole purpose behind it was money laundering. They felt that money was being stashed overseas and it was facilitating money laundering, and that to combat that, they passed the legislation that for anybody an American who has foreign accounts, that if they exceed $10,000 in value, they have to report them every year to the Treasury Department. It's not actually a tax form. You don't report it to the IRS. It's going specifically to the Treasury Department. And you disclose the peak value that each of those accounts hit. So it is an aggregate value. So if you have two different bank accounts, one that has 6,000 in it, one that has 5,000 in it, together they were over 10, so you have to report them both. There's no tax associated with reporting. There's no liability associated with reporting unless you don't do it and they catch you. But in terms of actually just disclosing it, you're just simply telling them the bank name, the bank address, the account number, and the highest value that it hit during the year. So it's just simply a requirement for people overseas. What happened was in the 70s, this was the case. And then until probably, I would say, early 2000s, the federal government and everybody just kind of forgot that this existed. Because it had to be filed by paper. You were mailing it on paper to, I think, some office if I'm not mistaken, in Utah. And nobody knew whatever happened to them, right? It was just these paper documents circulating that I'm sure nothing happened. It's just piled up somewhere in an office. But in probably about 10 plus years ago, they kind of, I don't know where it came from specifically, but they were looking at the issue again and said, wait a minute, we have this on the books. We want to start enforcing this. And then sort of they stepped up, notifications to everybody. Hey, remember this law still exists. This requirement still exists. And they started really kind of pushing that information out. And they were very generous. They said, look, if you haven't been filing, if you do the last 6 years, we're not going to penalize you. We'll call it good. Yep. And you'll be in the clear going forward. So that's happened now. They've modified it now. They call it Form 114. It's still filed online. You still have the same obligation. But what's happened is along the way, I think it was 2014, maybe 15, they came out with a legislation called FACTA, F-A-C-T-A. And if you're an American overseas, you run into this even if you don't realize you have. And basically what the U.S. government said was, for financial institutions abroad, if they want to have American clients in their banks, that the banks are required to collect their personal information, including their social security number, and the banks themselves are required to report those peak values back to the U.S. Treasury Department directly. So if you've gone to open a bank account in several countries nowadays, you go there and they'll ask for your social security number. They'll ask for a W-9 form for you to provide that to them because they're complying with FATCA. And the big stick on this is the U.S. government said, look, if you don't comply, they're talking to the foreign financial institutions, if you don't comply, we're going to have a 30% tax on any of your U.S. assets. And so, of course, all these banks did one of two things. They either complied, or two, they said, we don't want Americans anymore. We don't want to hold accounts for Americans. You need to take your money elsewhere. We just don't want to mess around with it. Now, each country has been able to negotiate a different relationship with the IRS as it pertains to that reporting. Some things are done centrally. They're just reported locally to the government and they don't get sent to the IRS. Other ones it's done directly. So there's been some of that happened. But the whole purpose behind that now is that whereas before the IRS wouldn't know, or Treasury Department wouldn't know how much you had overseas, you're self-reporting it. Now they're going to know, right? If you don't file an FBAR form and saying you have $50,000 overseas, and your bank does file a form saying you have $50,000 overseas, you're in the position now of having non-compliance, and they have proof that you weren't compliant, and that's where the penalties will probably start in on. So it's something that's a pain in the neck to do. Everybody's pretty frustrated with it because unlike other things that have been indexed to inflation, like the foreign income exclusion, right? It goes up every year. It's now 130,000 because this has this inflation indexing. Well, the FBAR never did. So $10,000 in the 1970s was a huge chunk of money.
Huge. Yeah.
$10,000 now, it's not so much. So there's been a push to say, let's raise the limit to 50,000. Let's do other things to make it make sense. But the reality is, as expats overseas, you don't have a really large tax voice. There's not enough people. I mean, there's millions of expats abroad, but in terms of the impacting of the tax treatment and other things, it's really hard to get noticed in Congress to make changes like that. So we soldier on with the 10,000 limit for reporting.
We soldier on indeed. Where can people find these tax forms?
So irs.gov is going to be the primary place for all of those. The website, I don't remember the exact link. It's called the Financial Crimes Enforcement Network, which is the site that you go to. It's a little bit intimidating when you get there. It feels like you're kind of doing something wrong, but that is the right site, and you can fill it in online. There's firms out there that'll pay. You can pay. They'll charge you $200 to do it, but honestly,
it's crazy.
It's not that hard. It really is just taking the time to record it, submit it, and be done with it.
Agreed.
So, I mean, I know a lot of people don't like it just purely on the basis of why should the American government need to know this, and that's a battle you want to fight. Fair enough, but I'm just telling you what's required, whether you do it or not. Hey, that's between you and the IRS.
Right on. Okay, so flipping the script a little bit, what do expats, non-American expats, need to do living in the U.S.? What's their filing like?
So a non-American living in the U.S., it really depends on their visa status. And there's dozens of options, and it depends on their country. So, for example, the U.S. has a unique treaty with France that if they come and if a teacher moves to the U.S. and teaches for 2 years, they have no federal income tax for that 2-year period.
Wow.
There's a few other reciprocal agreements that work in some other countries around the world similarly. Korea has the same kind of thing, Japan, China. So it depends. There's some trade agreements or some we call treaty agreements that kind of govern some of those taxation things. But for the most part, in the U.S., once you become considered a resident of the U.S., then the U.S. becomes your primary place of taxation. Very similar to what we talked about in Europe a few minutes ago. If you're there over a certain number of days, then that becomes your tax home. So there are some visa statuses that will do that. But ultimately, you become a tax resident. And if you're a tax resident in the U.S., you have to report your worldwide income to the U.S. as well. So if you have a rental property in Spain and you're living in the U.S., you have a requirement to report that income as well to the U.S. as part of that process. So there's a lot of those requirements that are in there. The issue with all of this is enforcement, right? I mean, there's not enough people, manpower, technology, what have you right now to keep track of that, right? If someone's living in the U.S. and they're working there and they have a rental property in Spain, there's no way for the U.S. government to know about that, right? They won't even know about the foreign bank accounts because they're going to be in the foreign passport name. So a lot of it is sort of an honor system reporting and doing it. With most of the IRS things, I guess, the reason the IRS gets compliance is not because people are sort of, I really want to pay my taxes, I want to do my good civic duty, what have you. Mostly it's out of fear of getting caught, right? And I think the IRS sort of plays up to that. It's sort of, if you don't do this, there's going to be a big penalty. So do it because there's a penalty. And so because the IRS can't enforce most of their provisions, they just have these big penalties out there that if you happen to be one of the unlucky ones that does get caught with it, you pay a lot, and there's not a lot you can do about it. So I do think, though, with a lot of the movement towards, AI type of things and more technology use and whatever, it's going to be easier and easier for some of this stuff to be found out, and then for the IRS to do something about it. Whereas right now they're understaffed, they're underserved, they're under technology. I mean, there's a lot of issues there with running the organization as a whole. But we take the approach of just be compliant, and you can sleep well at night knowing that you've done the right thing, just because you don't have to worry. If you're trying to dodge it and figure out loopholes and avoid this and avoid that, if I don't do this, they won't know about that. Very possibly that can happen. But then you've got to remember that you've kind of put all those things in place, and then how do you keep track of them, down the road? So anyway, that's our point of view anyway.
Fair enough. Well, let me ask you this, and I think we've kind of already touched on this, but I'll ask it directly. Do I need to report income from investments abroad to the U.S.?
Yes, absolutely. Yeah, it falls in the same category, worldwide income. It gets a little bit more complicated though, because there's normal kind of investments, where it's you buy a property and you sell it, rental income, that kind of thing. It's quite straightforward. But there's another category of foreign investments, which are called PFICs, which is considered a passive foreign investment corporation or company. And really what these are typically are what we call foreign mutual funds. And what the IRS has said is that if you fall into a category, if your investment falls into this category of being a PFIC, it's not as simple as just reporting the normal ways that you would do it. They require you to treat them very differently. And it's a very complicated form. There's several different ways you can use it, but most commonly what's used is what's called a mark-to-market kind of situation, where you look at your value on January 1, you look at the value on December 31, and whatever gains or losses happen during that year in the fund, you report those as you go. So normally in the US or other systems, you won't pay taxes until you sell something. So if you bought shares of Apple, you held it for 20 years and it went up 3,000% in value, you don't pay any tax until you sell. When you're dealing with these foreign mutual funds or these PFICs, you've got to report those gains every year, even if you don't realize the gains. If the gains are still in the fund and you haven't taken the gains out, you still have to disclose them. And it's a very punitive kind of structure. And so I would say that the purpose behind it is the US government doesn't want people investing overseas. I mean, they want them investing in US vehicles that are tracked, that the 1099 is issued, those kind of things. So they can't stop you. There's nothing illegal about it. You're totally able to do that. But the issue is you've got to be able to report the same information to the US government that you're required to do. And a lot of times you can't get that from the foreign structures. Your U.S. brokerage will give you a 1099, clearly outlines everything. If you go to your Swiss brokerage, they're going to, what are you talking about? You haven't sold anything. There's nothing to report. And the IRS says, no, there is. And that's what we want to know about. So if you're getting into the overseas investment piece, you just be cautious. There are some tax reporting things that you really just have to be aware of that could come back. And tied to that as well, and I'll just throw this on there real quick. It's probably another whole conversation about it, but is when people go overseas and they create foreign entities in a foreign country. So if, for example, if you want to go to Thailand and you want to stay in Thailand and you don't have a work permit, a lot of times you can create your own company. So you'll create a company, you'll hire yourself to work for the company, you'll issue yourself a work permit, there's certain criteria, and then you're able to stay in the country longer than having to do the visa runs in and out. Yeah. When you start creating these foreign entities, the U.S. government has a whole separate regime dedicated to that and what reporting you have to do, and it's complex. So if you're thinking about just setting up a company overseas and doing that for visa purposes or for holding assets or whatever, just make sure you look into the tax implications and what that looks like from the U.S. side.
Okay, I've got two rapid fire questions I want to ask you before my final question. First, do you have a larger tax burden? These are questions that people have sent in to us. Do you have a larger tax burden if I own real estate in the U.S.?
Not
so you're living abroad, but okay.
Not typically. I mean, and the reason, well, for the U.S., not typically, right? Other countries are different. The U.S. lets you offset your rental income by any expense that you incur. So your mortgage interest, your taxes, your property manager, your repairs, your maintenance, and on top of that, you take depreciation on the property. So by and large, most rental properties that we see, I would say maybe 1 out of 20 makes a profit.
Okay.
Most of them on paper, once you factor in all those elements, including the depreciation, they're losing money, right? So the U.S. isn't going to tax it in that sense. Foreign governments, though, may treat it differently. They might not let you take all those exclusions, right? They might say, well, what was your gross rental income? You made $30,000. That's what we want to tax. We're not going to let you offset it by all your other costs. So that would be where
and they might do a percentage deduction.
Correct.
I think in Portugal they do like
to what you could
50%.
Right.
Yeah, exactly. Okay, the next one is, do I have to file state income taxes? You kind of already answered this.
Well, it's tricky, right? Because, every state, there's two types. There's what are called domicile states and what are called residency states. If you're from a residency state, once you've left the state and you really aren't physically resident there anymore, the state really doesn't claim you anymore. Your ties sort of kind of expire. A domicile state, though, is essentially you're considered domiciled there until you take up a domicile in another state. So if you move, typically in the U.S., what would happen is if you move, let's say, from Pennsylvania to California, you've got roughly 60 days, 30 days, 45 days, depends on the state, but to update your driver's license, you update your voter registration, you update your address. And at that point, then you become a tax resident of that state. So between states in the U.S., it's quite straightforward. You have a process you follow because you've moved to that state and you want to take up residency, you can do those things. But when you move overseas, let's say you've been living in Pennsylvania and you move abroad, well, you haven't actually severed your ties to Pennsylvania. You're still kind of statutorily tied there. And if your driver's license is there and your voter registration, your family connections are there, that's where you go back every summer, that's where you have a rental property, whatever, Pennsylvania says, well, no, you're still a tax resident of our state, and therefore the tax rules apply. Now, some states are really particular about it. Others have a lot more allowances for it, but they do vary widely in terms of that. So it does depend on the state. It's not easy. Pennsylvania, I mentioned, is one of the more challenging ones. New Jersey is another one. Hawaii is another one. Massachusetts, a lot of them, they give you certain allowances that you can, Pennsylvania won't tax you as a resident if you have no property in the state and you're only in the state less than 30 days a year. Whereas if you have a property in the state, then they're going to consider you a statutory resident of that state. So it is important that you figure out what your state does in that regard and how do you make sure that as you're expatriating, you limit your liability to that state. It could be possible that, if you, let's say you left the state, you've been gone for 9 years and your driver's license expired, you go back to the state, you renew your driver's license, you're reaffirming to that state that they're your state of residency, right? So, sometimes it takes, when I left Virginia, for example, and I moved my residency to Nevada, I sent my license back to the state of Virginia with a letter that said, I'm done. Here's my license. I have exited, so that there were a very clear line that said, I'm not a resident of the state anymore. You have no claim on me going forward. So there's things you can do to do that, but it is something that as an expat, you do need to be cognizant of, specifically if you're from the East Coast, more so than anywhere.
Right on. How can your company's financial services help expats, and what are the general rates?
So, for us, we do tax work, we do financial advising. Our firm, we're a firm of expats for expats, right? So that's kind of our thing. We're not living in the U.S. trying to explain to people how to do this. I've been in Korea now for almost 22 years. Clients all over the world. We live what we deal with, and so it's not something just of we're advising in absence of reality. It's our practical reality as well. So we can help basically just doing advising, actually doing the prep work, discussing things in terms of financial planning as well as distributions of retirement assets, et cetera, as part of that. So really, it just depends on how deep someone wants to go. The fees really just vary by time and complexity, to be very honest. It just depends on what's involved. We can do a tax return for, $350 for a fairly basic return, everything included, federal, state, overseas exclusion, whatever, for, one income kind of thing with maybe a rental property, no problem. When you start getting to people that have, a multitude of crypto exchanges and cryptocurrencies that they've been trading in, and they have 2 rental properties, and they have now, they own a foreign corporation in Korea that sells pizza, or whatever it might be, then the complexity ratchets up really quickly because now it's not just one thing, there's a lot more happening. So it does vary. We usually recommend people contact us to ask, to basically share with us their income situation, what it is that needs to be reported. A lot of people think their cases are really simple, right? They'll say, my situation is really simple, but when we actually get into it, it's a lot more complex, right? So it's a matter of just kind of looking at it case by case and kind of working through with each individual.
And people can get a free quote?
Absolutely, yeah. Just contact us by email, go to our website. Just share us some information about either a copy of your last year tax return so we can see kind of what's involved there, or share with us, the income reporting that needs to be done. We'll give you an estimate up front before you get started. And once we give an estimate, it's pretty firm. If something changed during the process where we found something that really was a lot more complex that wasn't disclosed, then we'd come back and say, hey, this has changed the situation a little bit. What do you want to do? So no one would be ever surprised at the process.
Okay, awesome. Thanks for your time, Stephen. I appreciate it.
Yeah, no, I appreciate it. I appreciate the time, and this is tax season, so I think it's a timely thing. And anybody who's watching and hasn't done their taxes for many years, the IRS has catch-up provisions as well. So if you've been delinquent and not filing for years, give us a shout. We can figure out ways to help you.
Thanks. Take care. Bye.
All right. Take care.